The US dollar has spiked up over 158 yen. Traders are on high alert for intervention by Japanese authorities. Market expectations for rate cuts keep being pushed out, and New Zealand consumer confidence falls again. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, has been looking at why Australian consumer confidence is at the same lows as during the 1990s recession and when it might pick up.
What does it suggest consumer sentiment should do? And the answer is sort of through the second half of this year, so from July through to the end of this year, I'm expecting consumer confidence to start to recover and to head back towards something that's a bit more consistent with a long-run average level.
But first, in 5 and 5 with ANZ, the US dollar spiked nearly 2% late on Friday to over 158 yen after the Bank of Japan held its key policy rate and disappointed traders expecting some sort of tightening signal that would see Japanese interest rates stop falling behind US interest rates quite so much. Those traders are on high alert for intervention today from the authorities in Japan. Here's ANZ Group Chief Economist Richard Yetzinger speaking last night.
The dollar does just seem very strong in foreign exchange markets, reflecting that recalibration of Fed easing expectations. And the Bank of Japan and Japanese policymakers in general look right in the thick of it at the moment, and market expectations will be looking for some signal from Japanese policymakers that they're thinking about acting to try and stem the weakness in the currency. That will have been, I think, holding some market participants back, but the clock really is ticking to see what Japanese policymakers might try and do about the yen.
Number 2. So if the authorities in Japan do intervene, how much could the yen strengthen? And will it be able to hold those gains? Here's ANZ Head of FX Research, Marja Bin-Zaman, speaking late on Friday.
On a short-term basis, intervention from Japanese authorities will have impact on dollar-yen, likely towards the low 150s, as we have seen from historical ranges from previous dollar-yen reactions to Ministry of Finance action. However, we really do think that dollar-yen ultimately really needs lower US yields and a weaker US dollar to really move lower and stay there. Not so much hawkish Bank of Japan or stronger economic data in Japan to drive this.
The Aussie dollar starts this morning at 5 a.m. Sydney Melbourne time at 65.34 US cents, up a touch, and the Kiwi is slightly weaker at 59.39 US cents. Number 3, the big story in the global economy and financial markets right now is a shift towards seeing fewer, if any, cuts in interest rates in 2024 from major central banks, in particular the US Federal Reserve. And in this part of the world, the Reserve Bank of Australia and the Reserve Bank of New Zealand. Here's Richard again on what it's like being stuck between rate cut heaven and rate hike hell.
What's coming through is, what I've called interest rate purgatory. Mid-cycle slowdowns are really challenging for picking the interest rate environment. That's just their nature. You don't have an extended sequence of rate moves in one direction with a high degree of correlation across economies. You kind of have waxes and wanes all over the place. We're right in the thick of interest rate purgatory.
Number 4, the Reserve Bank of Australia is also subject to these changing expectations, with markets now seeing little chance of a rate cut in 2024. It wasn't so long ago they even saw the chance of a cut in the first half of this year. Here's Richard again.
Before the CPI number, there was some prospect that maybe it would be before November. Now, potentially the risk is it's a bit after November. Again, in Australia's case, this is interest rate purgatory. I think what was always likely was the Reserve Bank of Australia holding interest rates at what is a contractionary level for an extended period to ensure inflation comes back to target.
Number 5. In New Zealand, consumer confidence has fallen again to near its lows from the global financial crisis. Here's ANZ senior economist Miles Workman.
The fact CPI inflation is proving sticky, and perhaps consumers are coming of the realisation that interest rate cuts from the Reserve Bank could be a little bit further down the track than they previously thought. Ultimately, the Reserve Bank's not going to be in any position to cut interest rates so long as CPI inflation is looking like it's going to be above target, and that's what the recent data have been telling us.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ Head of Australian Economics, Adam Boyton, talks about why Australian consumers are so down in the dumps and what might change.
If I look at the ANZ Roy Morgan Consumer Confidence Survey, we see that consumer confidence in Australia is at about the same levels we saw in the early 1990s recession. And if I compare where we are today with where we were in the early 1990s recession, of course, the unemployment rate, just to take one indicator, is in a demonstrably better spot today than it was back in the 1990s. So this weakness in consumer confidence has been really an interesting feature of the past 12 months or so.
So how have you gone about figuring out what is actually driving that?
At a very simple top-down level, what we find is that weak level of consumer confidence or consumer sentiment is a function of the fall in real household disposable income per capita over the past year. Now, that sounds like an absolute horrible mouthful, so let me break that down. When I'm talking about real per capita household disposable income, what I'm doing is I'm looking at the incomes households have. So that's all your wage and salary income plus income, say, from social security benefits, those sort of things. And then you're taking out interest payments, tax payments, and then making an adjustment for inflation. And then what we're doing is making another adjustment for population growth. And so what we're really trying to do is start from a big picture aggregate in the Bureau of Statistics quarterly national accounts and break it down into this question of what might that big picture aggregate in the national accounts look like for an individual person once we take into account their wages, once we take into account also, really importantly at the moment, higher interest rates and relatively high inflation. And what we find is that the weakness in consumer confidence or consumer sentiment is really driven by that weakness in per capita incomes once we adjust for inflation. What we've also done as a bit of a cross-check, if you will, on that is sought to model consumer sentiment. And if we put consumer sentiment in a more formal econometric model, what we find is consumer sentiment's a function of inflation, the unemployment rate, interest costs, tax payments, the performance of the stock market, and also where sentiment has been recently. So if I think about those things, I've got inflation dragging sentiment down, the unemployment rate should be pushing it up, but offsetting that good unemployment rate, interest costs are dragging it down, tax payments have been relatively high recently, that's dragging it down. And of course, the level of sentiment's been quite weak for a period of time, and that's sort of keeping it anchored, if you will, at these low levels, given those other influences.
Adam Boyton there. Tomorrow, Adam talks about what it might mean for the RBA if those Stage 3 tax cuts don't boost consumer confidence as much as expected. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, April the 29th. Get to tomorrow with a look ahead to key New Zealand jobs data on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.